Welcome to the Stacked Investing Podcast, where real estate meets real life. I'm your host, Greg Farricielli, bringing you the latest in investment, health, and mindset. Stay stacked. Welcome to the Stacked Investing Podcast. Today, we have a very special guest. He has a lot of hats. He is in the world of raising capital. He's in the world of short-term rentals, commercial, hotel, real estate listings. He's got a course. He's just all over the real estate world. Welcome James Kang to the show. He's got what I'm seeing over 100 properties with some people in Atlanta, some in Cleveland that he started back in 2015. Some of these he syndicated, but once he got through the apartments, he realized short-term rentals is where it's at and how he raises capital. And I'm so excited to dig into that to see what your business model is, what type of investors invest in that model. So welcome to the show, James. Talk to me, man. Tell me about the short-term rental. Tell me how you got into it and anything you want to tell me about a backstory.
Cool. Yeah. Thanks, Greg. Happy to be here. Thanks for having me, to be able to share my story. I've been in real estate in some form or fashion since 1999 when I was at NYU. I was actually a real estate agent doing rentals in Manhattan in 1999. It was really good money for a college kid, like really good. But then September 11th hit, and the real estate market in Manhattan went kaputs. Let's fast forward to 2012 when I really started to invest out of state, and really started investing in the model of like FERS, and personal investments. So I bought my first single family rental in Atlanta in 2012. We were picking up properties for 35,000, 40,000 back then, and getting $850, $900 in rent. And saw that, if we can go to auction, we can pick up a lot of properties out. So, brought in a few partners and we went down there and we started buying 5, 8, 10 at a time.
Okay.
We did that for a couple of years. It was working very well. And mind you, this was, we were buying like 2005, 2006 vintage. So pretty much brand new. So didn't need a lot of work. And then the competition started ramping up. A lot of during that time, like hedge funds would come in and buy 50, 100.
Okay. So
yeah.
I guess when you say you went out of state to Atlanta, where are you located?
I'm currently located in Philadelphia. But while I was I live in Philly now, but while I was doing that, I lived in Manhattan.
Was going into Atlanta, was that intentional, or did you have a reason to do that, or did it just kind of happen?
In 2012, I was looking to get back into real estate investing, and like a lot of people, I didn't read Rich Dad Poor Dad. I read the second book, Unfair Advantage. And so, back then I had no money. Couldn't afford to do that model in New York City, right? So I started looking outside. So I looked at Nashville, Dallas, Atlanta, and Charlotte. And I ended up in Atlanta. Number one, the flights were shorter and very inexpensive. And also I really had got into the show Walking Dead, and I found out that they shot it there. So I was really interested in checking that out. So it was intentional in terms of I was doing a lot of research in those types of markets. But if you want to get into like what I liked about the market, we could talk about that.
Well, I would love to know what you liked about it and what type of asset did you purchase in 2012?
So the reason I liked Atlanta, a couple things. Number one, if you did some research, I like to look at not just like the actual property itself, but I like to look at a lot of macro factors, right? Like things like what can you not build easily, like beaches, lakes, mountain ranges, or airports. And that was a big thing for me. Atlanta, I felt in the long run, would always have a lot of economic activity and job growth because of their airport. At that time, I don't know if it's changed, but at that time, it was the busiest airport in the world. And then, there's some tricks too, like if you look at U-Haul and moving truck data, there was a ton of people that were moving into Atlanta as well. So, and then that also added to the unemployment number, which wasn't kind of factual. They actually were starting to gain job growth. There was a lot of colleges there. Financial companies started moving there. So things like that. Rents were good, stable, and that's part of the reason why I went down there to invest. And the first property was a single family rental.
Right, and like so single family rentals, like you said before, 35, 40 grand into these?
Yeah, 35, 40 to purchase.
Nice.
Generally, we average around between $6,000 and $8,000 to rehab, paint, maybe,
Sure.
carpet. And they would, our first 8, we did Section 8. And, we were getting, gosh, I was looking, 850 to 900, you know? And then we started going out and getting market rate rentals.
So for the single family, what do they get renting for today, and what do you think they're worth per door?
Okay, so I could tell you pretty accurately because we sold off most of our product or refinanced, and we did the same business model in 2015 and transferred that to Cleveland. But right now, it's probably 235 for
Okay,
average, and rents. I'm getting for our single family house now we're getting 1,400.
nice.
Yeah,
So almost a double increase in less than a decade, theoretically.
yeah, yeah, and yeah. So we did well, and
Okay.
there was a lot of development projects going on there that we'd have to do a deep dive, like the Beltline and Pond City Market.
Did you 1031 into the Cincinnati properties?
No, so what we did was we refinanced and took that and brought it into Cleveland.
Got it. So you did a cash out refi. You basically did a long-term burr, bought it
Mhm.
into the other ones. Awesome.
Yeah.
So from there, how did you get into the STRs? Where does that come into? How did that transition over to that?
Well, there was a step before that. I syndicated a couple apartments in Atlanta. Obviously, when as real estate investors, and you have 3, 4, 5 years of success, and you want to be able to scale, apartments was the next natural progression. Um, so I did that a couple times as a once as a LP, twice as a GP lead sponsor, and we did okay. But what transitioned me to short term rentals. A buddy of mine had told me about in 2016, 2017. He had been like a OG in the short term Airbnb game. He did it for since 2014, 2013, and he wanted me to evaluate his short term rental business. Because he has all of his properties. I believe at that time he had about 8 properties in this small town I've never heard of in New Jersey.
Interesting.
And so when I looked at his numbers, I was blown away. Actually, I didn't believe him.
He was
Uh,
doing in New Jersey.
in New Jersey, short-term rentals. And I actually, yeah, I to be completely honest, I didn't believe that he was doing the type of numbers that he was doing. Um, and so I asked him a bunch of questions, and at that time I was still working full time, and I had been working at the New York Marriott Marquis for 14 years. It's a big, huge convention hotel in Times Square in New York City. So I'm very familiar with hospitality. Enjoyed it, and you coming from the single family rentals to apartment syndications, and then seeing these types of numbers that he was making, margins, right? It just was like, okay, well, if we can combine a bunch of all the things that I've learned, single family rentals, hospitality business, plus when you do the apartment syndication, you learn how to raise money, you learn how to rehab and add value and push the NOI to increase the value of the apartment refinancing. So, I told myself I was actually looking at 2 markets in the Jersey Shore, Ventnor and Atlantic City, because, even though they had terrible reputations, the first rule of real estate is location. And you're talking right next to the boardwalk, right next to the beach. So if you're able to find properties and make it work, long term, I felt like there was a great value add play there. So, looked at a few properties, talked to some people, and then I got into my first short-term rental property using apartment syndication model. All right. So what I was going to do is I bought an 11 unit, and I converted it into a 5 unit short-term rental property. We tripled the NOI.
So
Um,
11 unit multifamily building, you turned into a 5 short-term rental.
right. So originally we were going to convert all 11 units into short-term rental. But when I did the underwriting and I did the profits and expenses, it didn't make sense to convert all 11. The sweet spot was converting just the 5 because remember, in the short-term rental business, you're paying for utilities, you're paying for cable, and also you have the capital cost of rehabbing the units. So we took the 5 best units and we converted them into short-term rental units, and that actually improved our NOI, our net operating.
What did you do with the rest of the units?
So one of the units, sometimes when we have one or two of the units, we rent out to exchange students during the summer because our neighbor he has two bed and breakfasts and a restaurant. So he in the summertime it's super busy for him, and he has exchange students come in. He has no room, so we rent it out to him, for the summer. Um, we use one room for storage, and then we've added three staff members. Two of them stay with us in the building. They live in there, and in lieu of rent, they help us with everything that we need. If guests need something or if we need some handyman work, and we work out a deal. So yeah, that's what we do with the other units.
So I guess the question would be like, what is the difference? Do you remember the difference between the NOI and on the 5 unit and when you had the 11 unit?
Right. So, granted, we would have brought in more money, but the expenses on an additional 6 units to
Sure.
convert to operate would bring down the NOI actually.
And you're using it to bring down the operations cost of the business itself against just renting them long term. So it's probably more beneficial for you, for the employees to stay there where you just trade the rent.
Yeah, and you also have to understand it's New Jersey, so I really did not want any long-term tenants
Okay.
in this
So it
building.
wasn't the market for that there. Wouldn't be the highest and best
Well,
use.
also, well, it's very, very, very tenant friendly. So had we had an issue, remember we have 5 short-term rental units in the building that are producing a ton of cash. I didn't want a long-term rental tenant to be bothered or them bothering the
Sure.
guests, or if what if they were not paying rent and we had to evict them? New Jersey takes a long time. So
Okay. So
that's why
for
we just kept the whole, and it's a very touristy area. And there were no hotels in that area, in this particular area that we did this. So a lot of advantages to doing it
wow.
this way. And again, yeah, it was the same thing as the apartment syndication model. We more than tripled the NOI from buying it. And this is less than 3 years, and we went out and refinanced, and yeah, everyone was happy.
So are you still invested in that area in New Jersey? I'm assuming you still have that. Are you currently investing there?
Yeah, so we're only investing in those two areas. So right now, I still own that property. It's still doing very well for us. But now we are buying everything that we can in certain locations in Atlantic City, New Jersey. I don't know if you're familiar with Atlantic City. It's got casinos, boardwalk. So we're up to 15 listings in Atlantic City now. 15 or 17. I have to double check. And we like it so much. We like the business so much. And now that we've been doing for almost 5 years, I'd like to call us, experts and professionals in it. Now we're in the process of building new construction. We're doing a 24-unit mixed use, mix of 2 and 3 bedrooms, all short-term rental, with 2 restaurants and parking. So we're getting into the build to short-term rental, and
So
we
is
love the market.
and so is something like that where you're going to raise the funds, same model. Now, and are you refining these out, or are you keeping the investors in? And I'm curious to what type of permanent debt is something that you would want to structure into this.
Yeah, so these are opportunity zone funds. So you get taxed. You can, if you invest capital gains that you've realized in the last 180 days, you can invest that into an opportunity zone
So it's
and defer your.
almost like a 1031, but you just purchase an OZ property, like the funds, proceeds, everything go into that.
It's similar to a 1031, but the event. So here are the two big reasons why you'd want to do an opportunity zone. You can take capital gains of any type. So stock market gains, even if you have like a car collection, you sell it and you have a capital gain. You can put those, just the capital gains. You don't have to put the principal. You can take the capital gains and put it into an opportunity zone fund. Defer paying those taxes on that until 2026. And if you're in the deal for 10 years and we go to sell it, the gain on it is not taxed at all. So you can just cash out and not owe any taxes.
So it's just ordinary income or cap gains before that 10-year period is up, say if it's 5 years. But if you wait the 10-year period out, it's completely goes away.
Correct. There's no tax burden. Now, obviously, the income that is generated, it's taxed normally. And as part of the strategy that we have with the opportunity zones, especially in this area, is that you can still cash out refi, pull it out because tax is not, debt is not taxable, and still be considered in the deal. So you can still cash out refi, take the money out, and still hold it for 10 years.
So your cash out refining your investors that brought in their funds up for the syndication.
Correct.
Got it.
So, and
Okay,
then
so
there's two
you
ways you
make your
can,
money with the permanent debt, the appreciation, the better NOI, and then you just probably get most of your money back. What does the LTV look like for something like that?
when on refi.
Yes. For like commercial refi for
Yeah,
STRs.
we've gotten up till 75%
Okay.
on our other stuff. Now it's changed. Now, obviously, it's changed even for multifamily, right? Like,
Right.
I think right now that you can probably only get like 50 LTV, I would say, like, is the best for anything, anything commercial. So we're in the process of construction. So we're not, I don't know, once it's complete, we have 8 to 12 months of income to show. I don't know where LTVs will be at that point. But these are extreme value add plays.
Right.
And
I just wonder if there's a mix, like you can get your 50% LTV with permanent debt and raise some investor money if you wanted to
oh,
cash
yes,
out of
yep,
an additional 25 or 30%.
yeah, and that's how
Almost
we
like
that's
in
how we're
second
doing it.
position. Okay.
Yep. So we have investor capital into it. We will either set it up as a syndication or a partnership.
Mm. Sure, because
Partnerships,
you may not need all of them. You may be more of a JV because you don't need as many people.
correct, exactly, and that's a 24 unit short term rental is basically a 24 unit hotel
Sure.
without overhead, right? So a
Sure.
24 unit will make the same income as a 100 unit apartment complex, but like you said, you need less money, and so a JV would make sense, and it also it helps that if you set it up as a partnership versus a syndication, it's easier to meet the qualifications for the opportunity zone. So it does make sense in this case to do it as a partner.
So, okay. In Nashville, for instance, Nashville's my main market, and people
Okay.
bought Airbnbs for years and years, and then they changed the regulations on certain zonings. How are you able to make sure that your zoning isn't having any regulation change? Yes, I understand you're probably buying already existing hotels and using the same usage, but what type of zoning risk do you have in those areas, and how do you mitigate that risk?
Great question. And we've been going through it the past 2 years.
Sure. Okay.
So going in, that was a big concern of everybody's. So there's two or three ways that we really try to mitigate our risk on. And though, and before I even get into that, I do like markets that are regulated, right? Because then you know what you're getting into. Whereas opposed to, like, if you looked at Philadelphia, they were unregulated for years. People jumped in and then they just passed a rule, and this rule is probably going to eliminate 80% of Airbnbs, right? So two things. So if you do buy commercial properties, they tend to not be in neighborhoods. So they're more in a commercial district, right?
Sure.
And it's also a little bit, if you're closer to these areas, it's also very touristy. So they want that business. It brings in business to the local businesses. Okay. And number two, with Atlantic City specifically, we only invest in the tourist district, because
So
if you are out,
there's a tourist district in Atlantic City.
yes, which is governed by CRETA, which is more state run, and you don't have to. You're not under the jurisdiction of the city, so then, like, all the city ordinances. But they did pass a lot of like, you do have to go through the buildings department to get your short term rental license.
Sure.
And it's not cheap, and they want to make sure that you are keeping your property up, etc.
So do they have like a certain amount of people in a district that could use the same usage?
No, not that. No, that won't. That they don't have, and I think they would get in trouble if they did do that, because you do have casinos,
Sure. Yeah, yeah.
and
Because a lot of municipalities will have I live in a small town in Gulfport, Florida, and I think it's like you can only have like a few hundred of a certain district in each district short-term rentals, and there's waiting.
gotcha.
But that's obviously a neighborhood, more single family area.
Right. And we do own a lot of single families. We converted a couple single families into duplexes, but again, we are in the tourist district. We're right next to restaurants and bars, right next to the hotel, and they want that kind of business to come in. So you got to know
So
your administration too, the city administration. You got to know, like, what.
I'm sorry. I'm assuming you have your hotel taxes.
Yep, we pay hotel taxes. Well, I believe they're called occupancy tax there, but it's essentially what you said, a hotel tax. Yeah.
So also in Nashville, there's an additional tax on certain areas close to downtown where it's like if you're like in Lower Broad, there's an additional like 3 or 5% tax just for being in that area. Do you have to deal with that as well?
Yes. Yeah, but that's all. We still pay the same taxes as the hotels.
Sure.
We still have to pay for the short-term rental licenses per year per unit. And again, but we're happy to pay it.
Yeah.
We're just we're doing so well on the daily rates, and we're seeing a huge influx of institutional capital that have come in over the past 4 or 5 years. And so the next 4 or 5 years is going to be Atlantic City to be completely different.
Okay. So with all this capital raising, all you have going on, do you have any particular deals right now that you're trying to raise money from investors?
Yeah, just the current build.
Tell me more about that.
So we have raised 1.2 million already for the seed round, which allowed us to purchase the lot.
Okay.
I stopped raising capital because we went through a redevelopment process with the city.
Okay. Like a rezone kind of thing.
Not a rezone. So they want redevelopment in a lot of the areas of Atlantic City because it's been run down for so long. Okay. And through this process, we are allowed to, so there's 4 additional lots that are touching the lot that we own. Okay. And so we went to the city and said, hey, we would like to get these lots. And they told us we had to go through the redevelopment process. What that did was it took those lots off of auction. So we didn't have to bid with other investors that
So who did you buy it from then?
the city.
Oh,
It's
so the
owned by the
city
city.
owned these lots
Yes.
and they were getting ready to go to auction and you got to a city official beforehand. Got it.
So then we went through the whole process, and that allowed us. So that we and so that plus the permitting was going to take a certain amount of time. So we stopped raising money.
Right.
Because I didn't want the
You don't
time.
want to hold it.
Right. So the seed round, as an incentive, we offered 9% pref for the seed round. But now we're going back out into the market, and because of the additional lots, we went from being able to build 12 units, 1 and 2 bedrooms, to 24 units, a mix of 2 and 3 bedrooms. So and then that also saved us about 2 years of time by being able to build, because the original plan was to build a total of 20 units eventually, but now we can just do it all at once. So do we go out and raise the rest of the money for equity, or do we get financing and juice everybody else's percentage ownership that are already in it? So, but right now, as you know, interest rates, etc., we're just kind of weighing the pros and cons. But we do have a little bit of time, and we're being patient because we're still going through the permitting process. We're still negotiating prices of the lots, etc.
Do you have an idea of how much you would want to raise if you didn't finance, or maybe a rough amount of if you did?
Yeah, so right around 10.2 million.
10.2 total.
To finish the build. And then, but it makes all the sense in the world, because if you use conservatively a 40% occupancy on this build, on the short-term rentals, the building should easily be worth 16 to 16 and a half.
And then you can cash out refi that.
Exactly.
So what is the GP LP split for, would you think, roughly, for something like this?
Yeah, we're going in right now, it's 20% GP, 80% LP, and then certain hurdles go 30-70, 40-60.
Okay, so you have a step down.
Yeah, we have waterfall. Yeah.
And what is your prefs running?
So again, the seed round, the original 1.2 is 9% pref.
Right.
And then 6% pref for the remaining if we do go out and raise
And do
capital.
you take advantage of depreciation and stuff like that for the investors that invest as well?
Yeah, you can.
So you do a cost study. If they want to take it, they can. Some people cannot do bonus appreciation because they're not a real estate professional.
Right.
So they can use it however they want.
Yes, and so we don't do any losses during this period because there's no construction or anything.
Sure.
So once we do a rehab or construction, then they start getting the real crazy write-offs and depreciations.
And how long do you think the LP would have to stay in the deal?
About 4 years.
Okay, so you think you could
before we were ready to refinance.
And
you mean? Oh, actually, no. For the 10 million.
Yes.
In the next 24 to 36 months, we should be able to build, have 8 to 12 months of income, and then we'll go out to.
And then those investors will probably have to stay in, how long do you think? 4, 5, 6 years, 10 years?
For the after that, they should be able to recoup 75 to 100% of their initial investment. And then again, there's
a minimum investment?
200,000.
Okay. So 200K minimum for a 10.2 raise, 6% pref with an LP, 20 and 80-20 split, and then that can step down.
Yeah, and then the waterfall, with
what type of raise is it? Is it a B raise where you have to know the people, or can you just advertise it?
Yeah, you would have to. There's a certain arm's length. The rules have changed. But again, this is set up as a partnership, so it's a lot easier in terms of qualifying and not breaking any rules.
Great.
But I'm I'm not advertising for it personally online or anything like that.
And you're not, like you said, you're not even really ready to go move forward with collecting funds anyway.
Yeah, no, we are now, just
Oh, you are
because we know in the next 60 days or so we should get we should get approvals, and then we're going through the permitting process. So yeah, we want to make sure that we're rolling when we're ready to build.
Okay. Is there anything else you want to cover for our listeners before we go?
Yeah, maybe just what I like about the market.
Tell me more. Yeah. Tell me what you like about the market for that
Yeah,
property.
I mean, I don't know how familiar you are with Atlantic City, but casinos and boardwalk. But in 2016, it was the worst year that Atlantic City had. I think they defaulted, and they were bankrupt, and they lost, like, a few casinos went out of business, and the state took over. But ever since then, Stockton State College, they opened up their second campus in Atlantic City, and it was so in demand and popular that they just built another student housing facility with 400 to 500 beds. There was a wind farm, Ørsted. I believe it's a Norwegian company. They won a contract from New Jersey to build these huge wind farms off the coast in the Atlantic Ocean, 10 miles off. That would generate enough power to power 500,000 homes. And the governor awarded that to Atlantic City. So Atlantic City, that should create jobs, a bunch of permanent jobs, construction jobs. Hard Rock spent almost $600 million transforming one of the Trump Taj Mahal into a Hard Rock. Caesars Entertainment, they're spending $400 million rehabbing their 3 properties there. Nobu Sushi came in. They built, they have the Nobu Hotel. Right across our lot that we have, they're building a state-of-the-art 125,000 square foot marijuana grow house, which is going to change the whole area. We didn't buy our lot in a dead zone. We're a block from a Starbucks. We're right next to the Tanger outlets. We're a 7-minute walk from the convention center. We're a 4-minute walk to the new medical facilities that just opened up, and there's also a $3.2 billion development about a mile from our area that's being worked on right now. So yeah, a lot of things to like, and they have their own highway. They have the Atlantic City Expressway, so easy to get in and out of. And there's a couple things that they have that you can't just build, right? They have the ocean, they got the boardwalk, and they got the casinos. And the casinos and the convention center are doing a fantastic job with the off season and also during the summer peak season with doing a lot of shows and conventions. So we're seeing a lot of activity even in the winter. So our places are still booked up in the wintertime. So awesome. That's something that we didn't really underwrite into it. We only underwrote basically our places being booked during the summer. So anything on top of that is great.
Wow. Well, do you have a pitch deck that you mind sharing with me for the listeners if they want to invest in the deal?
Yes, I do. I have to do a pitch deck for the 24 unit.
Sure.
I wrote up a 1-pager, but I do have a pitch deck for the 12 unit.
Sure.
But you could just double it. And,
yeah,
I'll send it over to you because this was something that we found out about 4 months ago. We were ecstatic, like that we could go from 12 to 24 units just by adding these lots.
Yeah, that's crazy, man. Congrats on that.
Thank you.
Awesome. Well, thanks for coming on the show today, man. We got a ton of great nuggets. Learned a lot of stuff today. I appreciate you for sure. How could people find you?
You can email me, my original real estate company, James, at jjh-co.com. You can go to the website as well. My short-term rental company is Stay Coastal Capital. So the website is staycoastalcapital.com. And those are the 2 of the best ways, or you can just message me on Facebook.
Awesome. Well, thanks again.
All right, man. Thanks, Greg.
See ya.
Thanks for having me, dude.
Anytime.